Okay. Okay, welcome everyone to today's webinar. I'm so excited to be joined by the Troy Eckard. Thank you so much for being here today. You guys have such an amazing company, Eckard Enterprises. For those who are at InvestorCon, they are a preferred partner. They're at InvestorCon, and I love what you guys are offering in terms of passive investing opportunities. And I love the topic of today about how to do due diligence when you're vetting whether it's sponsors and deals, especially right now, there's a lot of uncertainty out there. There's a lot of syndicators and people giving keys back to the banks, and people that are passive investors are a little concerned, to be honest with you. And that's the nature of what we see right now. So I love this topic because it's been needed all the time, Troy, but I think it's needed especially right now in what we're kind of facing. So thank you so much for being here, Troy.
You're very welcome. Thanks for having me. I really am excited about the topic, believe it or not, of due diligence, even though as boring as it sounds, because ultimately every dollar that we lose, it takes $5 of effort to replace it. And so it's important for your audience. It's important for investors today. And I think this is a great time and topic.
Yeah. And, I'll share a little more about Troy. And I'm sure you'll be introducing yourself. But Troy and his team manages over 850 million in mineral rights and oil and gas properties, and what they offer is such a important alternative to what a lot of women in our community just park their money passively in syndications and things, and they don't know about all their options as passive investors, especially for those who are accredited. So just love this topic. Thank you for being here. For those who are joining us, thank you for your time. I don't take that lightly. We don't take that lightly, especially now more than ever. There's like 25 million things you could be doing with your time. So thank you. We want to make this as valuable and as insightful and as action-oriented as we can. So before we kick things off, I'd love for you to just share with us your name, where you're calling in from, and most importantly, what is your intention with this call? What is your intention to leave in an hour with? Because if you don't have an intention when you go into something from a learning perspective, you leave with, that was a nice webinar. Period. And Troy runs an enormous company. Ariel, one of his team members who we've had the pleasure of working with. These are busy people. These are very smart people. And I'm here with you too live. So we want to make this time well spent, but we need to know what your intention is. So what is your intention? What is one thing you want to learn? I'd love to see that in the chat box as we get going, because it's our goal to make sure that happens. So I'm just going to take a quick peek here. I got to see some chat happening, or I'm not going to continue. Hopefully it's not disabled, because that's happened before. I'm like yelling at everyone on the chat box and they're like, Liz, it's disabled. So I don't see it. Okay. I see Troy was able to chat. But your name and where you're calling in from and what your intention is for today. I'd love to see that happening in the chat box. But I won't yell at anyone or force anyone, because that's going to get awkward. But I'm going to give you the floor, Troy. Thank you for being here. Hey, Amanda, as I look for PMLs, I want to learn how to portray myself as worthy of their money. That's a really good perspective, right? Both on the side of you're looking for a lender, right? You're looking for passive investors. Very cool. All right, Troy, I'm going to give you the floor. Thank you so much for being here, and appreciate it so much.
No problem. I'll do a brief rundown on the due diligence and then open the floor at any time somebody asks a question. Otherwise, I'll just let you guide me and tell me how you want me to respond, because quite frankly, it's a lot of information in 30 or 40 minutes, but it's very, very valuable. So I'll get started and see where we end up.
And actually, real quick, if you have questions, I think, especially due diligence, there's going to be some very specific. I prefer if you can put the questions for everyone listening in the Q&A box, because then we'll be able to field them in a very focused way versus in the chat box where everyone's chatting about other things. So please put them in the Q&A box. And like I said, about quarter after, 20 after, I'll come back on, field some questions, and also share a couple of things, and we'll continue.
Sounds good. You ready to get started?
Yeah, let's get going. Thank you again.
You're welcome. Let's see if I can get her to load. That's always the trick. Will it cooperate today? Well, first and foremost, I want to thank everybody for coming today. One of the things I found over 40 years of being involved in investments, I started my career in 1985. I have been on the front line witnessing very successful investors lose millions upon tens of millions of dollars by being in wrong investments. And one key catalyst has always been failure to perform the correct due diligence. And due diligence is not just two words. Due diligence is an action plan. It's a verb. And the way it's stressed is that it's something where you're due the diligence of finding out the facts and the details before you make an investment. And I would say the due part, the DUE part of that due diligence is you're due that information. Okay. And it's that you need it in order to have the facts, the data, the support to justify garnishing the trust that you might provide or give to somebody asking you to invest or buy something from them where they're in the position as a fiduciary or somebody that's a sponsor. So let me just give you a brief background because it'll help you understand why I like due diligence, why I think it's so critically important, and why I can speak to it today. I started off in 1985 as a licensed FINRA broker. After about 2 years of representing a small firm in Dallas, I recognized that the company had significant deficiencies. Most of it was in just pure processes and management. But what I wanted to do was I wanted to find a way that I could bring assets and investment opportunities to my clients without having all the pitfalls of poor management, poor deal structure, lack of due diligence, lack of empirical data, all the things necessary to be successful. By 1991, so let's say 5-6 years into my career, I ended up with my own investment firm called Eckard Investment Services, which was a FINRA firm. And I had everybody from Wall Street to every kind of investment opportunity out there coming to my door saying, hey, will you raise money for us? And you get really, really good at understanding the dynamics of due diligence, whether it's a complex opportunity or something fairly simple. My background and my expertise is in oil and gas. And oil and gas is a very difficult asset class with probably 95% of those in the financial services having no clue how oil and gas works. So I was able to combine a really strong developing career in oil and gas with a really detailed structure on due diligence. And by bringing those two together, I built Eckard Enterprises, which now I believe is the industry leader in the country in private direct oil and gas investments in mineral rights and drilling and exploration. And that was because of a 40-year career. And so what I want to do is walk you through some of the things that I see, what I've seen. Maybe you'll take some great notes on this. Maybe you'll have a lot of additional questions. I put down in the chat my cell phone number. I always take cell phone calls. I'm probably the most proactive chairman of the board you'll meet. I've been doing this for a long time. I love what I do. And I really enjoy not only helping investors, educating investors, but also the clients that we have here at our firm. So let's just talk about, and this asset class list could be another 100 names, okay? So I've seen everything from selling ostrich eggs back in the 1980s to the dot-com era when all these dot-coms were popping up. So it's just a different day and time. It's just different asset classes, but it's always the same game. Somebody has decided they want to chase a venture. They need capital to do it. They look at all the different choices, whether it be a bank, private equity. They look at all the different choices in which they can collect capital. And then they began to start raising money. And then investors, depending on how they are introduced to that particular sponsor, have to decide, are the fundamental cornerstones of this particular idea, are they in place? Well, what are those cornerstones? So I'm going to give you some examples, what I believe some of the cornerstones are, and then you can decide if you want to add to it or if you agree with what I'm leading you into. So I look in today, we have a lot of debt funds out there. By the way, debt fund is a broad word. Okay. It's a broad word because they come in all sizes, shapes, and colors. You've got ATM funds, you've got real estate syndications, oil and gas, carbon capture, crypto, mobile home parks, fix and flips. And let me tell you something, what I'm seeing today, which is what I thought we would see 3 years ago. I was saying very loudly on my podcast, very loudly in my presentations, we're going to see some of the largest Ponzi schemes and fraud that we've seen since 2008 major crash, because none of the numbers worked, none of the fundamentals of due diligence were in place, and investors had made so much money from 2012 or 13 forward that it was kind of funny money. And when you make a lot of money, a lot of profits, it looks very easy, then you're having to spend it kind of carelessly. And I think investors let their guard down, and the sharks were in the water, and the sharks smelled blood, and they were able to put together lots and lots of syndications and joint ventures and all kinds of structured deals, many of which were just flat out Ponzi schemes, and many, which still we haven't seen the end of it yet, are going to be complete financial failures because the fundamentals of due diligence did not exist. So the key steps for me, and this is me, 60 years old, 40 years in the business, I start off with the who. I was very fortunate to have a billionaire as a partner about 16, 17 years ago. And he didn't care what deal you had. He didn't care what opportunity you had. He didn't care anything about the documents, the offering document. He said, I get to know you. It's the who. If I don't trust you, know you, spend time with you, ask you questions, see how you answer, if I don't know who you are, I could care less what you're offering. And so I was fortunate to be around somebody who made themselves independently wealthy, very wealthy. And I learned going through his investment banking processes, his private equity groups, that the who really didn't matter. And so when I talk to anybody about an investment, I want to know the who. Well, they say, what does that really mean? What is who? It's three simple little letters. The who is, if you were to invest in ABC company, I want to know who owns it. I want to know the ownership breakdown. Why is that? Most scams and bad deals have a front person or persons. The real owner that owns 85 to 95% of the stock and benefits from all the ill-gotten gains is hiding behind a front person. And the front person says, I'm president, I'm COO, I'm whatever the title they give themselves. And they're out churning and burning, raising capital, where the real money winner is the person behind the scenes. And you say, well, why are they behind the scenes? Well, there's two reasons. One, they have a very storied past. They've got cease and desist orders, frauds, felons, you name it. They've been bankruptcy 7 times. So they're not going to pass the general sniff test whenever they put their antecedents out there for you and I to look at. So they put the front person in place. So we have a hidden bad actor behind the scenes. And the second reason why the who factor matters is I want to know who's getting the money, because I want to see if they're aligned with my interest. I also want to know, are they an expert at what they're telling me to invest in? Have they been selling frog farms and all of a sudden now they're an expert in selling mobile home parks? They're not even close. So the who is incredibly important. And I don't want just the owners. I want the C-suite. I want to know who the COO and the CFP, and I want to know who the chief financial officer. I want to know everybody that's involved in this organization. I want to see their record. If you go onto their website and you don't see a full detail of their antecedents, and I'm not talking the last 3 years or 5 years, tell me who you've been the last 20 years, 30 years. I want to see if you won and failed and where you've been and how many companies you worked for. If I don't see that, I'm pretty much closing my book of interest and I'm moving on, because the most fundamental part of an investment is who's standing behind the scenes, and that is going to manage your money, make the recommendation, and brings the credibility of the investment itself. Now let's take the next step. Let's say I get past the who. Well, then I want to have questions and answers, and I want them answered. See, the problem is investors ask a lot of questions, and a smooth salesperson knows how to answer you without answering you. They're trained how to answer a question without answering. And the way they do that is that you ask them verbally questions, they'll skid around it, they'll deflect you, they'll ask you in different directions. So what I've had a tendency to do is say, I'm going to send you a list of the 10 most important questions to me about your investment or your asset. I'll need you to respond to those in writing, please. And I'm going to wait. And if I get 2 or 3 out of the 10, I close the book, I'm gone. If I get all 10 out of the 10 questions, but they're really brief answers like yes, no, or maybe, then what it tells me is 2 things. You don't really want to answer the questions. I'm probably a nuisance to you, or you really don't want to earn my business, because the reality is I am the customer and I've asked you questions. I wouldn't be wasting my time as an accredited investor to ask questions if I didn't need the answers. And the answers are a reflection of what I'm going to experience after I make the investment. See, when you make the investment, they're all nice to you and they want to get your money in the door. But after you make the investment, a lot of times you'll ask questions like, hey, what's going on with the project? Hey, where's the distribution? Hey, are we going to refinance that? And you get nothing but a eh. And that is the problem. If it starts off with the inability or lack of desire to answer your questions, it only gets worse from there. Now, I want to know the motive. Now, this doesn't have a thing to do with people making money. I want the person that's managing my money to make money. I don't want broke people managing my money, because broke people make bad decisions. Broke people are more worried about putting food on the table than managing my assets. You can't give somebody $1 million, $2 million, $5 million your money expecting to work for 1%. It doesn't work that way. If you do, they could care less whether you have your money protected or you make a profit. I want people to make money. I just want to know what their motive is. Like, why do you need me to participate in this? Why didn't you get bank financing? Why didn't you go to an institutional partner? Why haven't you gone a different direction? Now, I'm not upset with the answer, but I want to know the motive, because the motive tells me what our project or our directive is. Are you asking me to take all the risk and you want the lion's share of the profit? Are you asking me to put my money up and you're going to have no skin in the game because all you want is the cash fee? Well, that really scares me, because at that point in time, I'm thinking, is there any really value in that asset you're putting me into? So I want to know your motive. It's really important. Then when I get to the due diligence process, well, there's 50 basic questions you can ask, but there's always like what I call the top 10 questions. The top 10 questions are the ones that should be the easiest to answer. The question is, are they going to answer them? And most of the times they don't. If they're really good at what they do, if they already have an established track record, they have an established reputation in the industry, most likely they probably already have a preset Q&A that says, hey, here's the top 20 questions that we get asked, and here's the answers, and let me just go ahead and send you a PDF of those so that way you can take a look at what our answers are. Now, you might want to embellish that and expand upon it, but they're really simple due diligence questions, okay? So it is the details. It's not the arm waving. What a lot of salespeople will do in selling investments is you say, well, you guys are buying this apartment complex. When will the distribution start? Well, instead of answering a simple question like June of 2025, they'll say, well, based on refinancing and according to the liens that we have, and if we have an actual second lien that's taken out first, then we'll do a mortgage-backed lending opportunity. And you're listening to this jumbo going, I have no idea what you said. Just give me an estimate of time. Well, that's because it's the arm waving. And the arm waving is to deflect from the fact either you're not going to like the answer or they don't have the answer, or the answer they give you means now they've got something in empirical, factual form they're going to have to respond to and respect. The arm waving is a deflection to get you to invest without answering your questions. There should be a minimal process or expectation of due diligence. See, you call me, I meet you at a conference, I see you on a podcast, I want to invest with you. Well, what comes next? Well, how many projects have you done? Where are they located? How much money have you raised? How much money have you returned? What's the frequency of your distribution? And you go through this whole due diligence process, and depending on the level or the degree of your investment, you may not ask a bunch of questions in a due diligence process chart like I have on the screen. You might say, you know what? I'm not going to ever control it. I'm a limited partner. I'm a LLC member. I'm not going to control the board. So there's a lot of questions that it doesn't really matter. I have to choose to be in a passive passenger in the backseat position, or I plan on taking enough interest that I want to know who's running the boat, who's driving the car, and what do I want to do if I need to get out of the car or change directions. So depending on your interest, depending on the amount of money invested in that asset relative to your net worth, you may have a varying degree of the amount or the depth of due diligence that you'll take. Now, when I think about due diligence questions, again, I could come up with 50 or 100. I'm really good at reading people. So part of my due diligence is my second question may be completely predicated on the first question and the answer I get. So I'm going to give you 5 or 10, but that could completely change depending on the response I get from the person I'm asking the question. So when I say the sponsor of ownership, who is it? And they go, well, it's owned by a private group out of New York. That's just a bunch of shareholders. They all started companies like this, and they're buying, real estate assets across the country. Sounds great, but you didn't answer my question. Who are they? What's the name of their company? I want to look them up. I want to know, have they been in 42 lawsuits? I want to know that if I go online and Google it, they're notorious for setting up ventures, taking in investor capital, and then bankrupting the asset, leaving all the investors high and dry. So I'm asking you who. I didn't ask you what they look like or their characteristic or their size. Who are they? Depending on how they answer, if it's clear cut and they give me direct answers, then that's one check. That's good. They told me exactly who they were. They didn't hesitate. Now what I want to know is, do you have, before we get started about this new car you want to sell me, can I take a look at what you've done in the automobile industry the last 5 to 10 years? In other words, I don't want to buy your deal. See, here's how a deal works. I'm sitting outside a hotel in San Francisco. Guy walks up and opens a trench coat and says, hey, we want to buy a watch, lifetime guarantee. And I'm like, lifetime guarantee? You're selling watches underneath your trench coat, which means my lifetime guarantee means until you round the corner, I can't ever find you again. So I want a detailed track record. I don't care if you started 12 months ago. If you said, hey, look, we're a brand new venture, started 12 months ago. I got 20 years of history in managing and doing what I'm doing. I decided to start my own firm. I've only done one transaction so far, and here's what it has, but here's why I'm right. I know what I'm doing. Well, that's something worth listening to. But if you don't give me a track record, if you don't give me a performance, if you don't tell me what you've been up to and show me in numbers and data, then I have to believe either A, you just started, which I don't want to be the first one out of the gate with you, or two, you got a whole lot of failed ventures or carnage or bad events in the past that you hope get buried as fast as you can. And guess what? That doesn't float with me. You keep going down the list. I want to know, do you have any criminal activity between your owners, your managers, your C-suite, or any of your key personnel? And I want you to tell me in writing. Does anyone have felonies? Does anyone have any current pending civil lawsuits or any kind of pending criminal action taken against you at this point in time, against your owners, your managers? Why? A lot of these companies will hire people who have really shady backgrounds because why? They're already in trouble. They've already got a felony. They've already got themselves in trouble. They're already bankrupt. And they go stick 5 or 10 people on the front line and say, we don't care what you do. Just go raise the money. If we get busted, we'll say, oh, Johnny, yeah, we found out he was embellishing the truth. We fired him. We're so sorry. We'll make it work. Well, I don't want that. I want to know who's involved in the transaction from the person behind the curtain all the way down to the person that's selling me or talking to me. I want to know, is anybody in that chain link convicted felon, criminal, being sued, barred and banned by the SEC, or any kind of regulatory problems, right? Again, this is just part of a sampling test, and I'm going to try to keep this concise. So what's in it for you? And I want to know why. I don't care again. I want to know what's in it for you. Well, I want to make a fee to pay my bills and cover my staff. Okay, I get that. You want to run your business. I understand. Okay, what else do you want? Well, I'd like to know that if it worked out and you get your money back in a certain preferred return, I earn my equity by getting 20% after payout. Well, that's fair. If you give me back all my money and I earn 10% return and you want a 20% back in, that's reasonable. As long as you don't have a bunch of hidden fees and have a bunch of hidden items in there that strip down my ownership, and really my chance of getting my money back plus my preferred return is so watered down, you don't really even count on your equity. You don't care because you know you're never going to get it because the asset's never going to perform. That's why I want to know, what skin do you have in the game? What are you bringing to the table? How are you getting paid? How do you run your business? And what do you really want from doing this transaction? Nobody works for free, and I get that, but I want to know what you are working for. Will you give me copies of contracts and deeds? Think about a real estate transaction. I'm raising $5 million for this building, and I've got it locked down for $5.5 million. And once you guys fund it, we're going to close, and I'll manage our own equity. Really? Send me the contract. What I don't want to do is have in the document of the offering document $5.5 million. What I find out is really he raised 5.5 and he goes back to the seller and says, look, I'm ready to close. Here's cash in the bank. It's my cash in the bank. Really, it's you and I and the investors' money in the bank. And I'm not closing for 5 million, but I'll close for 5 million instead of 5.5 million. And he makes a $500,000 fee because what he did was he beat down the seller by saying, hey, I have proof of funds in the account. We're about ready to close a week before closing, but I'm going to back out unless you take $500,000 off the price. Person selling it finds himself in a pinch. The guy that's created the sponsorship, that's the sponsor of the venture that I'm invested, says, thank you very much. I get all the fees I told you about, and I made an extra $500,000 because why? You agreed to pay $5.5 million. No, in the document did it say, I agree to pay what you pay, and I don't have a contract copy that tells you those kind of accolades or items are inside that contract. Proof of concept. Now, this is one that's really critical at the bottom. And I know some of you are not experts at reading documents. You're probably not even experts at creating the documents, but the offering document tells you a great deal. So I looked at a venture about 18 months ago. It was an asset class that a lot of my clients were investing in, and they kept showing it to me. It was in the energy space. And I said, within 5 minutes, I said, that is a Ponzi scheme. It does not exist. It does not work. That is an out and out Ponzi scheme. And they didn't believe me. So I said, well, here's a list of 20 questions. Ask the questions. They didn't get the answers, but they asked the questions and they kept on investing. Then what happened is I got a copy of the offering document and I looked at the document. It's probably one of the most well-written offering documents I've seen, all in favor of the sponsor, the person raising the money. It was so well written where literally the investors had no rights. It was not rude. It was not in your face, but it was so well written. I'm like, when you give this person your money, you will never have the ability to ask any questions or interfere. Anything you do, he's going to have the right to have recourse against you. That document smells 100% like, once I get your money, you're in a mousetrap and you're never coming out. As it pans out, about 60 days after I looked at that document, it was announced that the feds had arrested him for $157 million Ponzi scheme. The business was never in place. He stole money from day one, and that document was the best written document to cover him. Had he not been ferreted out, no one could have ever questioned what he was doing because the document was so well written. So you better look at that document and ask yourself a question. Is the document so one-sided that it prevents me from ever just having the right to find out what's going on with the money I invested? Or is it reasonable that says, I'm going to manage things, I'm going to handle it for you, you're a passive LLC member, you're a syndication participant, I'm going to do all this, but I am subject to audit, review, litigation, arbitration. In other words, if the document's fair, I know it's got to be one-sided because you're going to be the manager, but I don't want it so one-sided. It says, if you breathe air and I don't like you, I can have a countersuit against you. That's how that document I described was actually working out. So it's all up to you. And this is where I find the biggest mistake, investors, candidly, is that people get busy. You're making $1 million a year. You go, okay, that's only 25,000. I'll give him 25,000. He rips me off. It's not going to kill me. Here's 50,000 here. Here's 100,000 in the apartment complex. I didn't have time to look at the financials, but I know Johnny. Johnny knows Tommy. Tommy knows Susie, and they all say it's a good deal. So thumbs up, we're all in. And then all of a sudden the economy slows down like it has in the last 18 or 24 months ago. Why did I do that deal? Those terms are horrible. Why would I have bought that apartment in that geographical area? Why did I do this investment over here? I would have never done that. Well, when we have haste, we don't take our time. We don't run due diligence. We don't get those answers. We don't look online and Google their names and find out who's behind the scenes. We don't build a character model around who we're investing with. Then what you're going to find out with that magnifying glass is I miss some of the most basic fundamental things. And quite frankly, they are fundamental to the very core of whether an investment has the right intentions or whether it's disaster from day one. So when I think of asset classes, I just go down and show you what I see. I see carbon capture, ice machines, mobile homes, ATM machines. Tax deductions have been the irresistible bait used to snag investors. They say, I tell you, if you say tax write-off, tax deduction, investors lose their mind like they're drunk on wine. And what they do is they forget all about the fundamentals of making money. For me, I'm simple. I'll pay my taxes. I want to make money. I'll take the 63% that I can keep after paying my taxes and invest it wisely. Unless the investment or the asset class that I'm considering truly has the ability to make me money and make me a good financial return, I'll write my check for my taxes. So I don't look at things like this. Now, why is it? ATM machines, water machines, carbon sequestration, mobile home parks, all these things popped up for one reason, because Donald Trump gave us big tax write-offs, and that's what set the pattern. Go ahead, Liz.
Oh, no, finish your thought. I don't want to cut you off.
No, I was just simply saying
yeah.
that there's a lot of asset classes that popped up in the last 24 to 36 months, all driven off of Trump's tax plan. Almost all of them have turned out to be complete Ponzi schemes or failure because investors lose their common sense thinking, I got to save taxes. I don't have to save taxes. I got to preserve my wealth. There's a big difference.
Yeah, really good stuff. So many great takeaways so far. I want to field a couple of questions here to keep everyone engaged and make sure
Sure.
get you some water there. Kathy, you're asking about what does proof of concept what will you provide me in terms of access to proof of concept mean? Okay, what will you provide in terms of access to proof of concept mean? I guess what does proof of concept mean? That's the best.
Well, Liz, I always look at it when somebody says, hey, I'm going to buy that building. Hey, I'm going to do this apartment complex. I'm going to build that RV park. I'm going to start the self-storage. My question is, have you ever done it? So proof of concept means show me that you've actually gone full rotation through your business model. So for like me,
yeah.
Well, you say your minerals are going to do X. Show me that you bought them, turned them on, cash flowed, you have performance. Otherwise, there's no proof you can do it. And that increases dramatically the risk because you have no proof they can actually do what they say they can do. That's really big.
Yeah, no, it's a great point. So like in the multifamily space, it would be that someone's taken a building full cycle, meaning they bought it, they've added value, right? They've renovated or increased rents, whatever their business plan was supposed to do. They've sold it, and you see what percent of profit they were able to give in return on the investors' money they were able to give back.
And like in multifamily, you see a lot of this. Hey, it's a 12% pref or whatever it is, but they say, but internal rate of return is going to be 26.3%. Okay, you've been around for 5 years. Show me any one or several that have actually done full rotation and achieved that. Well, they're all close. Well, you have no proof of concept, so that means there's a lot of blue sky in your presentation.
That's a really, really good point. Sarah, great question here. She's asking, I just reviewed a subscription agreement with a clause giving the sponsor power of attorney of limited partners. Would you also consider this to be a red flag?
Absolutely. Why would I give you my power of attorney? See, the whole concept in a fiduciary capacity, whether you're a general managing member or general partner, is you have a higher fiduciary duty to your investors than you do your own spouse in a marriage. Yeah. When you ask for power of attorney, you're basically, it's like your medical. It's like me saying, hey, my wife's going to have full medical authority over my power of attorney. She goes, well, you're going to an insane asylum next week. You can't do that. Hey, you gave me power of attorney.
Yeah.
What I've seen, Liz, in a lot of structured ventures is that the managing member creates power of attorney. They then go and borrow against the assets because they have the power of attorney. You think your assets are kicking off cash. And one day you go, hey, it's not going as well. We ought to sell the assets. And they go, you don't own the assets. He pledged the assets because of your power of attorney to another bank, pulled out $40 million and went and spent it. Now the bank that you borrowed the $40 million from the sponsor is gone. You have no assets. And you gave him the authority to do it. He didn't break the law. You let him do it.
Wow.
There's no way I'd give anybody my power of attorney. It happens all the time.
Yeah, great question, Sarah. I mean, this is so helpful to share, right? Because people are doing this or have done it, and it's like these are the things you got to catch. And you don't have to be the only ones looking at the documents, right? You want to use the people around you. That's why we're so committed, Troy, of building Invest Her. And that's really what we're about. And I will say, use our resources to bounce passive opportunities against the community. That's why we have a Facebook group of 17,000 women. It's a free group. And if you're considering maybe working with a sponsor, working with a passive opportunity, from a deal perspective, or from a, obviously, like you said, number one is always the sponsor, share it in the group, get some feedback. Has anyone heard of this type of project before and this type of sponsor? We also have our weekly podcast. We've interviewed various people. We've had you guys on our podcast. The whole idea is you want to keep, okay, what do I need to ask? How do I need to ask it so I make the right decision? So definitely check out our podcast, our Facebook group, and our local meetups, especially if the companies are local to that market. That's why we have meetups, 45 meetups across the country and in Canada. So use our resources, our free resources. And I also share that we also have a mentorship program where I see women constantly asking each other, hey, I could put this deal together. So you're almost like vetting women, at least our group, you're playing a certain level. So there's a trust factor, but you still have to vet, you still have to do your due diligence always. But you also want to be able to do due diligence within the right groups with people who have the right intentions, right? So I'll just encourage folks to keep engaging with our community. That's why we have a community, because a lot of this is a lot to do for yourself, right, Troy? You've built this type of knowledge base over many years of investing yourself, working with, probably tens of thousands of investors. Hard for one investor to acquire all this overnight. That's why community is so important.
Yeah, it's decamillionaires of education the hard way. When you lose 100,000, $500,000, $1 million, you're like, wow, that was expensive. And I got to be candid with you. Your CPAs, your financial planners are not very bright. No offense. They may know what they know. They do not know due diligence, because you almost have to be street smart. Like the old saying goes, if I want my house to be secure, I need to hire a professional robber to help me put my security system in, because these people who have no scruples and no morals, they will create documents that are 100% false. They'll create false bank accounts, et cetera. So as you walk out to those investments, just assume it's not the person who's the ugly looking, boogeyman that's going to take from you. It's the person who looks like they go to your church or they're your financial planner. And the reason they do that, they can get closer to you and the money's gone. I have a whole group that had one of their classmates from college after 30 years. He was the one behind the $157 million Ponzi scheme. Took advantage of all of his friends and neighbors. It was horrible, but they trusted him, right? So it is about really working a network. And what you said is highly important. After a long career that I've had, one of my oldest clients said, look, you mentioned any investment or any particular sector, I'm about 5 phone calls away from telling you who's involved. I can call Johnny, who knows Tommy. And I don't see current investors really doing that, Liz. I don't. They kind of stay isolated. They'll make 1 or 2 calls. But the truth is, if you'll just integrate yourself into the organization like this, and you'll share with others, you'll be able to help others do due diligence, but you'll also get the reciprocal effect by saying, we know that person and things did not go so well. That's not really defamation as much as it is, my experience was not something I'd give a 5-star rating. Let's put it that way.
Yeah, no, and that's so important. This is just Sarah's asking a follow-up question, which is a really good point, Sarah. She's saying, in case in her situation, right, with the agreement, she said she refused to sign it. They offered to change it specifically for them, and that gave her pause. So would it also suggest desperation to you? What do you think, Troy?
Well, one thing in the securities laws, I had my own investment firm for 22 years. One thing it also says, you cannot offer one favorable investment terms to one investor versus the other in a security transaction. And when somebody tells me they're going to change their contract, obviously they went to their lawyers prepared it and said, this is the way you're going to offer it. And they say, well, we need your money so bad, I'm going to change it.
Wow.
That is not a red flag. That is off the chart red flag. And now I'm going to say to myself, so one thing she could say, not in this contract, I tell her to walk away in a heartbeat. But what you can say is, there's a really neat clause you can add, which is called, I want a favored nations clause in the agreement. And that means I get the same deal as anybody else. Now I get the best deal of anybody else that's in the venture. So the question would be, is if they're saying to her, hey, I'll change that for you. Well, what the heck else did you change for the other 3 people? Yeah. Did you charge them a less fee? Did you give them a lower price? If somebody does that to me, I am out. I am gone. That means you're not really being truthful, and you're so desperate for the money, you'll do whatever you have to get it. I don't feed starving dogs because, quite frankly, half the time they'll bite you, right? I like pets, but I'm not going to get bit doing it.
Great point. I think that's so important. And, I will say there are projects right now that I'm seeing, Troy, and I'm also in the business, that are getting funded very quickly. And then the projects that you're like, oh, and they've been talking about this for like 2 years. And so
Yeah.
that's something that you should note if people are, in terms of, just what they have available in terms of an investment, and the ability to raise for it in this economy, right? So I think that's important.
I think investments, Liz, are like houses. When you put a house for sale and it's been on the line for 30 days, it's not priced right, or there's a problem there,
True.
right?
Something's
And
going
so,
on, right?
and investments are the same way. And
True.
sometimes some of our investments will lag. They normally sell out in a week or two. Sometimes they'll be around for, we have one that's been around for 3 or 4 months. It's because we had 5 at the same time. It didn't get funded as fast. It's just as good. But when you're doing what we do, multiple projects, you go, and I tell my team, I say, this one looks like moldy bread because it's been here for 120 days.
Yeah.
What the problem is, it's perception, but 90% of the time that perception's right. It's there because it's a bad deal, poorly structured, or it's a deal that makes no sense, or there's all kinds of elements to it that tell the buyers your red flags going off. Avoid it. You got to trust your gut instincts.
Yeah, absolutely. Okay, we're going to hold on these other questions we'll get to. So yeah, I'll let you continue on. This has been great.
I'm gonna slim through these last parts because I don't want to. I was told that maybe they want to hear a little bit about what we do, but I'm going to
Of
do it
course.
the same format. But let's just continue this. So I go to the second asset class, which is water stations, conservation easements, crypto, car washes. I've had so many clients getting conservation easements. That's the number one auditable item by the IRS. You might as well walk in the IRS office and slap them in the face, because conservation easements 2 years ago, everybody was told if you do it, you are going to be audited because they made no financial sense, and the IRS doesn't like losing tax dollars on what essentially is a shell game. Water stations were parts of equipment again. Car washes, that's been the hot deal. Car washes, really? I mean, I'm going to count on 5,000 people a month to go spend $5 on a car for me to make a return on my money in an inflation-driven economy? I don't think so. And guess what? It's a specific end use for the building and facility. So it's like a restaurant. What am I going to do with it if it doesn't work out? These are the things that got to make common sense. We've got to apply common sense by saying, what's the chances that business could go out of business? A lot, depending on your understanding, or at least your street smarts, or at least going out and looking at the property or observing the asset class online and saying, what can cause these to go wrong? Boom, here's 20 things. I don't want that one, right? Oil and gas, private debt funds, real estate syndication, equipment acquisitions. So private debt funds, I think, is the next hammer about to drop. I'm already seeing it. It's going like a freight train. I don't see anybody stopping it. I don't care if the feds lower the rate. Why is it? Well, you go to private debt funds because the borrower couldn't pass traditional lending agreements. So now you have this accelerated rate. So the questions you should ask is, are there any covenants? What are the covenants you ask of the people borrowing the money from the fund in which I put my money? Banks have covenants. If I don't have the right income, I don't have the right asset to value, loan to value, they call them. I've been asking a lot of my partners in the last year, I said, do you know in the debt fund you're in, were there covenants? Was there any recourse? Or were these people borrowing non-recourse without any covenants? And the debt fund sponsor is now stuck lending money to people who are completely out of balance, and there's no recourse against them. So they're going to hand you the keys back and go, I'm out, but thanks anyway for the money. There is so many due diligence questions that you should ask before you invest in an oil and gas syndication, a real estate syndication, a debt fund, because at the end of the day, once you write the check, you got blinders on and you've turned loose the steering wheel, and you're totally at the risk and you're totally at the success of the person who put the fund together. If they're sloppy, or they're lazy, or they're generating a bunch of fees by placing the money, they don't care if the underlying asset fails because they made all their money up front, which again is finding out what their motives are. So I think one of the things that I like in due diligence is it's super, super simple. It's simplicity at its finest, right? If you can't verify the opportunity, you don't have to get mad. I mean, I used to have a hot temper when I was younger. I'm still kind of a feisty old dude, but I used to say it all the time. I'd say, look, just walk away. Hey, I've asked you 10 questions. How's the answer going? Oh, well, we're getting those. Tell you what, you call me when you get all those answers. In the meantime, best of luck to you. Have a great life. One of the things I've learned in the last decade, because I got clobbered in 2008, so call it 14, 15 years ago, is I was a heavy investor and I was involved in multiple projects. And again, I was like the very people we're talking about. I invested in a lot of stuff going like, ooh, that was a dumb mistake. Ooh, I wish I hadn't done that. And what I found is I never got the answers to those projects, the ones that didn't work. I got enough to make me feel, okay, I'll try a little bit of this. But the truth is, if I don't get the answers, I'm not going to be mad and I'm not going to beg you for the answers. You want my business, I'm going to ask you and you can answer them. If I ask a question that's too personal, you don't want to answer it, just tell me why you don't want to answer it. I may agree with you. But failure to be proactive and respond and answer my question, the simplicity is, it's so nice meeting you and best of luck to you, but please don't call me back. Thank you very much. Adios. Don't care. And I don't care if 50 of my friends are involved with them. I'll tell my 50 friends, I wish you luck. That doesn't fit my profile. We don't want FOMO. We want to do what's best for us, right? If the who cannot be verified, this is massively critical. If the who cannot be verified, then it's got to be the boogeyman. So I had two of my clients call me, Liz, about a month ago, and they said, hey, we're in this oil and gas deal. They're asking us for cash calls. This is what's going on. I'm driving to work at 5:30 in the morning. And I said, well, who is it? They gave me the guy's name and company. While I'm driving, I Google it, okay, and I find out who the guy is. Within 2 Google searches, the guy had previous felonies for fraud, for this, for regulatory. And I go, did y'all not Google even like 2 Google searches? Yeah, I guess we should have. $1.5 million. They didn't spend time for 2 Google searches. That's the who is that really important. When you think about due diligence, I want to give you a visual. I'm very good at analogies, but do you ever think you would jump out of an airplane without looking at your parachute? You pack it yourself, you check it twice, maybe thrice. You make sure it's going to work. You make sure it's big enough to get you to the ground safely. It's your life that you have in your lines. Well, you've worked your whole career to make all this money you're investing. And I don't know about anybody else, but when I reverse out all the time I spend to make $100,000, I'm not taking 2 minutes to give it to somebody that I invest with that I've not done the due diligence with. I'm going to look at the value of the wealth and the net worth I have and say, it's important to me and my wife and my kids and my estate to put the same effort in holding on and protecting it as it did in making it. Thousands of hours to make it, you can lose it in seconds. And that's the critical part about due diligence. Any question at this point, or I'm going to jump quickly to the Eckard side, but I want to make sure I leave plenty of time for Q&A at the end. And since you're guiding it, you tell me, because I don't have to go over stuff and I can simply just answer questions. I'm good.
Yeah, please put any more questions. We had someone here say, as a novice, I've been duped and scammed. I'm so appreciating this information today. I wish I received it 10 years ago. So thank you.
You and me both, because as the teacher, I can tell you I've lost millions being scammed myself, because I got to be honest with you, when they want your money, they will commit every fraudulent act. They'll falsify bank documents, account numbers. These people have no moral compass. And so you're gonna have a good chance, if you're an active investor, having somebody take advantage of you. What you want to do is get hardened and smarter, not rude, but hardened and smarter by saying, I have a buy box, which includes the following items. If I don't get those, I don't wish ill will on you. You're just not getting my money. That is the strongest asset you have, is the ability to walk away and say, thank you, but no thank you. It's really critical.
Yeah, absolutely. I just put in the chat box. We put all of our recordings on our blog page. So check that out. That's where our podcast is. That's where all of our free webinars are. So check that resource out. Sarah, you're asking about, and I think you're going to share this now, Troy, do you have any podcasts or other instructional materials about due diligence?
I do on our app. So we built an app called Eckard Insights. You can go to our website and find it. And the reason I built that is that oil and gas, my business, is one of the most complex businesses out there, I think, for alternative investments. There's not a single site that you can go to and says, oil and gas 101, how not to get ripped off. How does it work? It doesn't exist. So we spent probably about $3 million over the last 3 years developing Eckard Insights. And the reason we did it is I wanted to bring oil and gas investment to mainstream. So in that app, when you sign up, you don't have to be accredited or not accredited. It's just information, but you just sign up saying, hey, I want to be able to access the data. I don't know how many videos on due diligence and debt funds and apartment complex. I spend all my time studying economics and finance and helping investors. So just sign up to it. It's all free. So that's probably the highest collection point of videos and data you'll find about oil and gas or any other asset class on that site. And we're continuing to build that library day after day after day, because no one else really has it. And I think it's highly valuable and critical to understand what's going on, not only in oil and gas, but in every other asset class. So just go to Eckard Insights, sign up, you get approved, and you have access to all the videos and information.
Ariel, is there an easy way to get that link in our chat box for people on here that can just click it and make that happen?
Absolutely.
Okay, cool. Because I think what you're saying is so helpful. What you're saying too, I hear you, and Aaliyah is asking, what is it, only gas? Sounds like the materials that Troy and his team put together are going to be helpful due diligence on any asset class. And obviously you guys specialize in oil and gas. So if you want to talk a little bit about what you do offer, because as a multifamily syndicator, as a passive investor, as a accredited investor, as somebody who's been in this industry for 20 years, I just really love what you guys are offering as such a powerful alternative to everything that's out there. So please share a little more about this as a passive opportunity, especially for those who are accredited.
Well, let's just make it real simple. Again, I like using photographs and visuals and analogs.
Yeah.
But what most people don't know is that when you buy real estate in the United States or you own it, you have three rights. You have air rights, surface rights, and you have mineral rights. The mineral rights is what's below the ground in terms of natural resources. It doesn't include water, okay? The reason why it's never been a big deal to most real estate investors is you're going to go buy an apartment complex or build one. You could care less if there's oil and gas under it because most likely it doesn't have oil and gas underneath those particular minerals. But because of the big shale revolution that occurred 15 years ago, and because of how large it is, covering almost 12 states, we now have full cities like the city of Dallas-Fort Worth is sitting on top of what's called the Barnett Shale, which was the first big gas discovery with shale drilling in the country. So you got DFW Airport over here, that's a massive airport, and they got wells all over the airport because they realized they were right in the middle of this oil and gas basin. So they owned the real estate on the surface for the airport, but they leased the rights for development to their minerals to Chesapeake Oil and Gas, who came in and drilled wells. And now they've been getting these big fat checks for the last 25 years, which basically pays for their airport, right? So as people began to understand, wait a minute, just because I'm in Ohio or West Virginia or North Dakota or Oklahoma or Wyoming, I better make sure that what I own, do I own the mineral rights or not? Our company has been a culmination of 40 years of my expertise in drilling. 10 years ago, 15 years ago, you would go drill a well. It was probably a 65% chance it was going to be a dry hole. You lose your money. The U.S. was running out of oil and gas. When this shale revolution took place, it was because of technology. And the technology allowed us to drill wells with about a 99% success rate. And we're making wells that can economically pay out in less than 24 to 36 months. Phenomenal production. Now we're the number one oil producer in the world. But within that oil and gas environment, there's one asset class, which is mineral rights. Now, what's a mineral right? When I own 300 acres in Oklahoma and I have a farm or a ranch, I also own the 300 acres of minerals below it. But I don't have $10 million to drill a well. So I lease the minerals to Exxon. Exxon says, okay, here's our deal. You own the mineral rights. I'm going to go out and spend all the money and drill the wells. I'm going to take all the liability, all the risk, all the environment. I'm going to go drill it. You get 20% of every drop of oil and every molecule of gas that's sold. At the beginning of the month, before Exxon takes his money, they set aside the mineral owner's interest. We get paid first. Exxon keeps the other 80% to pay for the drilling and pay for the cost and all the expenses. So just like a singer or an actor, you get royalty payments. You get royalty because we own 100% of the oil and gas that's under the ground. We just don't have the money to drill it. So by allowing oil companies to develop our oil and gas mineral rights, we get free checks for the next 25 to 100 years. Now, to advance it and make it more simple is, you say you're in multifamily, Liz. Well, if you look at the multi-story building, this is what it looks like underground. We got a reservoir geologically that's at 5,000 feet, 7,000 feet, 7,500 feet, 10,000 feet, et cetera. So we have this entire geological deposits of oil and gas that now, because of technology, it's not only economically viable, it's extremely profitable. And so we're not going out just saying, gosh, I hope somebody drills a well on my minerals. We physically are able to use satellite and online sites and technology and the internet. We now can look at Exxon, Chevron, anybody else's wells, determine who's the best oil company, who drills the most efficient well, who makes the best profits, where those mineral rights are at, how the wells are producing, and decide economically which ones make the highest profit. We didn't have that 10 years ago. This has all evolved in the last really 10 years because of technology. We now can look at any oil company's records and find out exactly who's the best of the best. So what Eckard does is we don't go out and buy 20 acres outside of town to build an apartment complex. We go in and say, hey, here's 4 acres right in the middle of the city. It's going to be leased up within 2 years. It's going to be at 98% occupancy. We want to buy mineral rights that are going to be fully developed and create the highest level of cash flow. That's what Eckard has been doing for the last 6 years. We now own just under $1 billion worth of assets as a result of using that technology, all funded without any debt through private investors like yourself. When you look at the opportunity, it's pretty simple. Residential, commercial, multifamily, you got property tax, you got labor, you've got expenses, you got insurance. Mineral rights, zero. No holding costs, no property taxes, no expenses, no bills, no management fee. We get a check in from Exxon, we cut it up into the 10 or 20 owners that we have that invested with us, and we send you a check. You either get an ACH or a check every month, and these checks will last 25 to well over 100 years. Our area is pretty simple. We're in Texas and Oklahoma. This is what it looks like. We're drilling wells to the surface. Minimal environmental footprint. Instead of having wells drilled every 2 or 4 acres, we now can drill on a 3-acre pad site. We can drill 5, 10, 30 wells at a time from one 3-acre pad site. All we're doing is drilling in what's the equivalent of a buried Grand Canyon under the ground And this is what it looks like. Just a whole system of wells drilled underground, minimal footprint on the surface, and we're now the #1 leader in oil and gas production in the world. When you think about that from a standpoint of protection, so let's talk about due diligence. We can show you the deed and titles of every mineral acre you own. It's listed on the Eckard Insights app. Your portfolio is listed on the app you can get to 24/7. No alternative asset has what we have. You can literally access your oil and gas interests just like you can your stocks or bonds. Everything is recorded. It's deeded. Every barrel of oil, every molecule of gas that's picked up by the oil company is recorded in the pipeline, the refinery, because the state of Oklahoma and Texas want their tax dollars. So we have multiple redundant sources to verify what's sold and produced. So you can take your check all the way down to the penny to make sure you're paid correctly. And what we've been able to do is we've been able to take what is really a very difficult, complex industry, and through 6 years of effort and a lot of investments in our company, we now have made this company the simplest, easiest way for somebody to own direct oil and gas interest with cash flow every single month. So we like it. It's about the truest passive income you can get because there's no bills. It all comes in, nothing goes out. And I won't get into working interest because it takes too long, but basically some people want to drill wells for the tax write-offs, but that's a whole nother day, a whole nother story. That's us. We like to send out thousands of checks every month. We don't send out bills. We send out money, and our clients love it because it's a one-way street. Just, as they say, more money. Just give me more money and stop talking, Troy. So that's what I try to do.
I love it. A question, Laura, do we need to be an accredited investor to register for free? So to register for that app, do you need to be accredited?
You do not have to be accredited to register. The only thing you will not get when you register is access to the current offerings because you're not accredited, but you get access to all the other data.
That's great. Yeah, please post any other questions. Really, really, really fascinating and helpful. Let me know if you have any other questions. What is your typical minimum requirement in terms of investment? Just out of curiosity.
So at any particular portfolio, it's a minimum of 25,000. Our average investor has got about almost 600,000 invested with us. So what we try to encourage is that you approach what we do from an asset class, not as just let me try you out and see how it works, but it's 25,000 minimum. Typically, our partners will look at doing 4, 8, 10 different portfolios. You end up with 2, 3, 500 producing wells or income in producing assets, and it gives you real diversification. Plus, it gives you a real opportunity for increased growth in that asset value.
That's great. Okay, Sarah, great question here. Got a couple of questions here. What do you see as the macro threat to your mineral rights investment?
The macro what?
The macro threat. So any threats to the mineral rights investment, anything that's outside of your control, I guess. That's what.
Yeah, I think the biggest thing with mineral rights for me, it was twofold. If you have an incompetent sponsor and they buy mineral rights in the wrong area, well, you're either not going to have them drilled or they're not going to have any oil and gas. So it's really about knowing your sector. And for us, what we've experienced is it's all about activation. You can have the best oil and gas deposits in the world if somebody doesn't go drill the well. So our model was set up so that way from day one, the minute we invest or buy minerals or you participate with us, those minerals are cash flowing. They probably have 3, 4, 6 months worth of back revenue coming to you. So you have checks right off the bat. We've got one that's going out first time this next month. I think the first distribution is almost 6 or 7% return in the first 4 months. So we're looking at that 10 to 20% cash on cash return. Just for the audience's benefit, green energy is a bunch of nonsense. They're not going to regulate private lands. It's private real estate. Fracking has proven to be very, very, very environmental friendly because it's mostly water and sand. We're looking at an industry that's being so reviewed every day by environmentalists that the Exxons of the world, they're reusing water, they're carbon capturing all the gas, the wellhead. Because there's so much attention on climate, this is probably the cleanest I've ever seen the oil and gas industry in my 40-year career. So when I invest, I know that I'm getting great production, great revenue, great income, but I know it's being done at probably what I consider to be the cleanest, most environmentally friendly oil and gas industry in my 40-year career, which I like.
Okay, these two questions are kind of similar. Is that what you're kind of alluding to? Is that how will mineral right investments be impacted with the 2050 transition to clean energy, net zero by 2050?
Yeah, it's not going to happen. So everybody always asks me that question about 2050. So here's the truth, and nobody wants to hear it, but I'm going to tell you, and then you can decide what you want to do about it, right? Yeah. So we started this green energy deal about 15 years ago, and we probably spent $10 trillion. We got windmills that are all over the place and solar panels and everything else. And look, we need alternative energy because at the end of the day, the more we can take off of fossil fuel demand, the better off we are. But with all that money spent, really in the last 10 years, we've gone up about 3 to 5% on demand for oil and gas. So whereas we thought by all this alternative energy, we would reduce fossil fuel, everything in my office and my screen is made from a barrel of oil. The shirt, the glasses, the watch, the chair, the carpet. So absent replacing transportation with something, or maybe electricity with something else, everything we use every single day is made out of fossil fuel. So that projection by 2050 was supposed to be we'll be phasing out of fossil fuel. But in fact, now if you go to the EIA, they're telling us we're probably going to be using 8 to 10 million barrels a day more than we used 2 years ago. Well, that's about a 7 or 8% increase in fossil fuel. Alternative energy will, in fact, take up more of the growth. I mean, if we grow this much more in consumption, it'll be a higher percentage of growth, but fossil fuels is actually going to go up 8 to 10 million barrels a day. There's no way to stop it. And one little hidden factor, Liz, really most people don't understand. You take away the subsidies for wind and solar, and you say just on a pari passu balance, crude oil, wind, solar, oil has to be at $150 a barrel for wind and solar to compare as an energy unit. So what that means is if you take away the subsidies, oil's got to get to $150 a barrel before wind or solar is ever going to be utilized. That's a pretty broad bridge to jump. So what's happening is utility companies, manufacturers, people that are consuming fossil fuels are saying, I'm going to go with oil and gas because it's so much cheaper. I can't afford to run my business. So it's all about, the economics, it's all about free enterprise. And I think the oil industry combined with government policy together can make it the cleanest fuel. It's going to be the most abundant fuel. But at the end of the day, we do need alternative energy. It's just not here today. And there will be no net zero by 2050.
Wow. That's really powerful. A lot of good insight there. What is the collateral? Aaliyah, sorry if I'm saying your name wrong, but she's saying, what's the collateral for my investment? What if there is no more gas left?
Well, you don't have collateral, you own an asset. So this is not a syndication. The way Eckard works our business is we'll go out and buy $10 or $20 million worth of minerals. Our company will retain anywhere from 15 to 20%. We then will charge a fee for the balance that we sell so we can make a living. And then you will actually get an exhibit that says, okay, I'm going to put $100,000, Troy, in your next mineral portfolio. You'll get a purchase sale agreement. That purchase sale agreement ties to the deeds that are recorded in the courthouse saying you own those mineral rights. And then what you'll get is you'll get a legal description of every one of your minerals. You'll get an exhibit that says where they're all located, and then that'll be loaded up to the app. So your collateral, or I guess I would call it securitization, will be your purchase sale agreement that says you own it, and the exhibit that shows all the deeds that are recorded in the courthouse of the minerals that you own. And that's all provided to you in hard copy as well as on the digital site, which is Eckard Insights. We're the only company that I know of that does that. Down to every single thing that you have and own, it's all recorded both digitally and hard copy.
And then it looks like you're asking a follow-up question there. What happens, let me see here. What happens when minerals are exhausted? Is that what you're...
So that's a good question because, quite frankly, we have been in the business for a long time. And what you realize is, it's like a nice 3-liter Coke. Once I drink half of it, is there anything left or is it all a flat Coke? Well, in the areas that we have decided to focus mineral rights, which is mainly the Anadarko Basin in Oklahoma and the Permian Basin of West Texas, we chose those two areas because they don't have a single zone. They have multiple reservoirs. And so there are parts of the country, like in Pennsylvania, the Marcellus Shale, where once you produce that gas, there's no more left, right? What ends up happening is commodity prices make what look to be obsolete mineral rights absolutely economically viable. Here's why. When you drill a well today at $10 million a well, and let's say oil is at $70 a barrel, you need about 200,000 barrels of oil just to pay out the cost of drilling. But if you get oil prices to go up to $80 or $90 a barrel, you might only need 130,000 barrels of oil. So today you could calculate how much value is your mineral rights based on current price of commodity and cost of drilling. You say, well, these mineral rights will be depleted in 15 years. The minerals that we're buying in West Texas, many of them started out in 1905, 1906. They were drilling vertical wells. Those wells have been online 100 years, still producing, still making money. And they now have leased, and they're drilling second, third, fifth, 10th, 11 different reservoirs, 20 different reservoirs. And so my experience has been only if you're in a single reservoir area do I have to worry about having a depleted mineral right where it ends up being almost worthless at the end. The IRS never lets you take a full tax deduction for mineral rights because it's real estate. Just like if your house burns down, they'll pay you for the house, but not the lot. Mineral rights always have a tradable value. It just may not be the same value you paid for it if you produce all the oil and gas reserves and there's no residual value left. My belief, after looking at what's happened in the last 2 years, Exxon paid Pioneer $60 billion. Why? It wasn't for the wells and the income that we're producing. It was for the 1,000,000 acres of minerals that they've leased, which probably is worth $500 billion or more to Exxon because of the reserves in place, the wells that can be drilled, and the long-term value of commodity prices pushing that number up even higher.
Wow. And Sarah, let's make this, we'll make this our last question and make sure, and then Jenna, I'm going to speak to your question too. Actually, let me speak to Jenna's question. Jenna's asking a little more about how to structure a small multifamily project, which is a great question. Let's take that. And if you can, Jenna, because I'd love to weigh in on that particular question inside the investor community Facebook group. Seriously, tag me and I will give you some direct advice on that, because I just want to stay consistent with the theme of today, but I'm happy to help you personally. But just tag me, Elizabeth Randazzi Faircloth, inside our Facebook group. Sarah, I'll put it in the chat box for you. Sarah, you're asking about what I meant to. Okay, is the mineral rights held as tenants in common? Can it be the replacement property in a 1031 exchange?
Yeah, so mineral rights, because they're real estate, are like kind of exchange assets. We have a lot of 1031 exchanges every year, and we have a lot of folks that are investing in their self-directed IRAs. So because it qualifies in both categories, I would say probably 70% of our investment capital comes from either self-directed IRAs or 1031 exchanges. And what most of our traditional real estate clients like about the 1031 exchange is they're able to look at the different mineral portfolios so they know what they're buying. They're already cash flowing at the time of the acquisition. It's almost immediate income. And those assets have 25 to 100-year well life. So what it does, it gives them a chance to stay out of the frothy real estate market, put it into something that's cash flowing from day one, gives you diversity. And then at some point in time, you can go, we built on our own Eckard Insights, we built our own market called P2P, or partner to partner. Let's say a year from now, I want to go buy another building. Well, put online, you want to sell $1 million of your portfolio. Other partners are buying other partners' interest, because it's probably the only active platform I know of in alternative assets where people can sell these types of assets partner to partner, and we don't charge a fee for that. So we've tried to think of everything: the exit, the entrance, the reporting, the documentation, the clarity. It's real important. I would like to make one comment, Liz, regarding your guest who asked you about raising money for multifamily.
Yeah, please.
Tell you two things. Most people who want to raise money forget to do it the right way. Start with what the investor needs and work backwards. And if what they need is X, Y, and Z, and you can't deliver it, you're never going to raise the money and the deal won't work. That's the first thing. Second thing is, there are institutional companies right now that can't raise $2 or $3 million. Raising money today is as hard as it's been in probably 20 years. So don't be surprised if every investor you're calling can't give you $25, $50, $100,000 because they're getting cash calls and deficiencies in multifamily. Last year we did about $330 million in capital raise. This year we'll probably do 200 to 250 million. We're just having an exceptional year, but we've been very fortunate because of results. But I've got a lot of institutional partners in real estate, and they're saying, look, right now it's very difficult to find $5 million, $2 million, because things are so stretched. So anybody that's looking to raise money, if you're going to get money in today's market, and it's going to get worse in my view, you better think about what that investor needs, because they're not going to listen to you. Their ears are shut off. People are not listening. They don't care, because there's enough carnage out there. And the big ticker out there, I can tell, Liz, is that everybody's saying distressed real estate is going to be a great buy. The question is it distressed today, or will be even more distressed in 12 months? And I thought I'd only share that because I talked to so many of my investors that are heavy traditional real estate, and the message from them on the front line is what I just described.
Absolutely. And something that we talk a lot about is conservative underwriting, right? And so many people are like giving these best case scenarios for all the stars to align. That is like a complete recipe for disaster. I want to see conservative underwriting and projections, and that's what I also look for too, as a passive, and also someone who puts deals together. But good question there, Jenna. It's possible, right? It's just there's a lot of pieces you got to think about, especially with the environment that we're in, that Troy you're speaking about so well. Listen, I am so grateful, Troy. I got a chance to get to know your team very well over the course of the year. We really appreciate Eckard's involvement in Invest.Her, and just thank you. And haven't got a chance to get to know you as well. And I am so grateful for the time. I thought I knew a lot about due diligence, and I I learned a bunch. So thank you. Thank you for
Well,
sharing
I'll help any way I can. And thanks
wisdom.
for having me on the show. I appreciate it.
Yeah, really appreciate it. And we put the note there. Ariel was at InvestorCon along with her colleagues. They are one of our partners. They're here not just to like, obviously they have phenomenal offers in terms of passive opportunities, but they're a resource. They're providing education, and every single one of our partners, that is like the number one thing that we vet for, because we don't just accept companies as partners without that process. So highly recommend you guys to connect with Ariel. Highly recommend to download the app. I'm going to download the app myself. Sounds like a phenomenal, because I'm super interested in what you guys offer as well personally. So everyone take an action. Do something with what you've learned. And I'd love to see that. I know we're a few minutes over. We like to start on time and end on time. We're sticklers, but this is such a wealth of knowledge. Please put in the chat box one takeaway, one thing you're going to do for those who are still on as a result of today. Just one thing, not 10, not 15, but something that you got from today's webinar that you're going to actually do, take action on, because that is how we move the needle in our wealth building goals. We don't do it by sitting and wondering and hoping. We get nowhere that way. We really get places, right, by taking action. So get the app. Yes, Angela, I agree. That is definitely something you should be doing immediately. 1031, Sarah, 1031 exchange 2 properties into one of Troy's deals. Awesome. Good to hear, Sarah. Sarah, I'm proud of you, Sarah, for asking the questions about, hey, does this look weird? I'm really proud of you for asking that, because sometimes we think we should know everything. We have these expectations, and I really love that you asked that question and you went with your gut, but I'm grateful that you did, and we can help support you. And certainly I know Eckard would love to work with you. Judy, calling Ariel to schedule a consult. Awesome. All right. Well, everyone, thank you so much for being on. Troy, thank you again so much. Really, it was a pleasure.
I appreciate it. You guys have a great fall, and thanks for having me on.
Ariel, thank you for all your support along the way. I know we're doing more together, so thank you so much as well.
Absolutely. Thank you so much for having us.
Take care,
everybody.
everyone.
Take care. Have a great day. Do something. Take care.